that's ludicrous. I've been saying this since back in the March event. I was saying we're going to see the lowest oil prices ever, and then a year later, a year and a half later, you're going to see some of the highest oil prices you've ever seen. And so here it comes, right? This is this narrative of inflation coming back, and where I think the icing on the cake for this is they just pumped out, what was it, 1.7 trillion in UBI checks.
Mm-hmm.
Okay. So now think about that. Every person's going to get these checks. They're then going to have some spending money for a little bit. They're probably going to have to do it again. And so these implications of everything coming back online in a fury, along with the UBI checks, along with the QE that's probably going to have to accompany it in order to keep interest rates down, even though the inflation gauge is going up, is going to just be a sight that I don't think most people were ready to comprehend.
What is up, guys? Welcome back to Bitcoin Audible. I am your host, Guy Swan, the guy who has read more about Bitcoin than anybody else you know. We have an amazing chat today with the one, the only Preston Pysh, all about the insane macroeconomic environment that we have found ourselves in, the inflation that no one is prepared for, the complete lack of an end game for the stimulus flood, the unraveling of our financial markets, and at the same time, the fact that we're seeing the maturation of the Bitcoin ecosystem, the establishment of real market interest rates, and exactly what that means for this Bitcoin cycle. How long does it last? And do we actually come back down this time? But before we get into it, I want to talk about our amazing sponsors. You need to be stacking sats with SwanBitcoin.com/guy. The automatic savings plan is the only savings plan for Bitcoin. It's the easiest and surest way to stack sats. I just automatically bought some today, actually, on the dip. I didn't have to do anything. SwanBitcoin.com/guy. And of course, make sure you have your funds securely withdrawn to keys that you hold in a simple, secure hardware wallet. The BitBox O2 is really easy to set up. The BitBox app is great and intuitive, and they have a Bitcoin-only version for added peace of mind. Check them both out at guyswan.com. But without further ado, let's go ahead and get into this awesome conversation. I had an absolute blast, and I'm so happy that Preston was able to join me on the show. Our chat on monetary revolutions with Preston Pysh.
Get it.
How long have y'all been doing that now? How long has that been show?
I think we started in 2013. So it's been a long time, man. Yeah.
That was in the early days of podcasting.
It was in the early days, man.
That really was, man.
I mean, we did it for I don't even know how many years where we didn't even make a dime. We were just doing it because we were having fun.
Yeah.
Years where we didn't make a dime.
Were you planning on making money with it, or were you just like,
just
there doing it?
We were just doing it because we truly loved doing it.
Mm-hmm.
And it was a good timing that like when we did start making money, because it was at that point where like, okay, like we've been doing this every week for years now. Like there really needs to be a little bit of a reward here for us. Okay, I got my local one going.
Awesome. All right. Well, I'm actually kind of curious about this. If you want to dig into it, I'd love to hear about like how the podcast started.
Oh yeah, sure.
Like I'm a big media geek myself. I have a podcast.
Yeah.
And I'd love to hear the history of that whole thing.
Yeah, no doubt. So it really started at a Berkshire Hathaway shareholders meeting. So Stig and I were at this meeting, and I was flying out of Omaha, and we were sitting there at the gate, and this guy, Hari Ramachandra, who we have on as a person who participates in our mastermind discussions, he was sitting there at the gate, And for anyone that's never been to the Omaha meeting, I mean, you meet some really interesting personalities out there. And so pretty much anyone you're talking to has a really unique story. And so anyway, this guy was standing there, Hari, and he had this jacket on and it had LinkedIn on it. And this is when LinkedIn was really kind of becoming a big Silicon Valley tech company. And I just started a conversation with him, and we immediately hit it off. We're both big value investors and fans of Buffett and this and that. And lo and behold, we get on the flight and we're sitting next to each other when we sit down in the plane. And so then we just kept talking, and he's like, have you ever listened to a podcast? I was like, no, what? I had heard of them, but I really had no clue even what it was.
Yeah.
And he's like, there's this guy, his name is Pat Flynn. You should listen to his podcast.
Oh shit.
And what was interesting, and the reason that I was talking to him was because I had stood up this website called Buffett's Books. And it was this website where I think I did like 35 YouTube videos that just teach people like the basics of value investing and whatnot. And so Hari's like, you need to listen to this guy's podcast, and he does all this passive investing type things, and maybe it would help you out with your website. And I was like, okay. So I put on my first podcast. It was Pat Flynn talking about passive income. And immediately for me, I was like, oh my God, I could create content that's just audio based and not have to do all this work that's involved in video content, right? Because the videos I'd made were like they were, value investing, but they had all these graphics, and I spent all this time like making these things because I didn't.
Video can be a headache, man.
It's a headache.
I'm getting back into it now, and I'm actually like, I came from filmmaking. Like I was a filmmaker before I went into like just deep tech stuff, and then came back around and got sucked into Bitcoin. And now the podcast, and now I'm like, shit, I'm doing video again. Like, so I've been like out of it for so long, and it's like, oh God, I forgot about all the headaches and the graphics and the things.
Oh my God.
It's kind of fun, but
it's one of those things that like, if you have a team that you're working with, like I have a team now, right? Like if I just want to record my voice, they can do all this animated stuff. Well, back then I was a one man show, and it was like, if I wanted to make a 15-minute video, like editing 15 minutes of video is terrible. If you want it to be like, all right. And I look back at some of the stuff I did then, and it's embarrassing, but, yeah. So that,
if you look 1 year in the past, it's just,
embarrassing.
It's
terrible. But, anyway, long story short, I listened to that and I was like, oh my God, I could create this content and it'd just be audio based. And like, it takes all this effort and like, the stuff that really takes so much time out of it, and you can just generate you can have these conversations with people, and I just found it to be just the perfect fit for me at that point. And so I reached out to Stig and I had conversed a lot on a forum about value investing, and so I was like, hey, you want to do this with me? Because he was Stig was the type of guy that he would show up on this forum and he'd have like a 10-page post, like getting into all the details of like some random oil pick. And so I just always felt like he was the perfect person for me to do something like this with. And lo and behold, like here we are like years and years later. And like I told you before we started, like we were doing it for years where we never made a dime. There was no ad. There was no nothing back then. It was just because we enjoyed having conversations and inviting people on. So it's kind of crazy to kind of see how it all evolved. But, if you don't love what you're talking about, you're never going to make it in any of this space because it's just so competitive now. But
yeah. I mean, that's what it is, right? Is that if you found something that you can devote 2 years to without making any money, you actually have a chance of making money at it.
Yeah.
Because sometimes it takes that 2 year of not making money to even get over the hump. And if you don't love what you're talking about, like I would never have done this shit for 3 years.
Yeah.
Like never. If it weren't Bitcoin, like what the hell? Good God, this is a monumental amount of work.
It's a lot of work.
Like at 6 months, I'd have been like, screw this. This sucks. I'm out of here.
Yeah, no doubt.
So now I hear you're a fan of Bitcoin. Is that right?
Huge fan of Bitcoin.
Good. Because that's what this show is about. How many shows do you guys have now? You got the We Study Billionaires.
As far as like other shows, yeah. So we have what is it? 1, 2, 3, 4, and we're gonna be rolling out a 5th show here pretty soon.
No shit.
Yeah.
What do you have? Do you have a Bitcoin centered one yet? Because
that's the one. Yeah, that's the one
that's the 5th.
That's the one that I'm doing right now, and I just started doing that. I'd say like September maybe or something like that. I started doing a weekly show that's just about Bitcoin.
Okay. All right. I'm going to have to add that into my role for dishes, things to listen to while doing dishes and laundry. It's the only reason anything in my house is clean is because of podcasts. So you found Bitcoin in 2017. 2015. Yep. Okay. Somebody, because I asked a couple people, I asked like my Audio Knots group for some questions or whatever. And I think they quoted you in like a tweet or something that you sold at like 17,000 in 2017. Like just at the peak, basically.
I got some sale orders at 18.
Nice. Yeah. Nice. Tell me what was going through your head. What was your perspective then versus now? How did you view Bitcoin? Were you already like really hardcore, like I'm doing this Bitcoin thing, or was it just a trade then?
So when I first got into it in 2015, the thing that really kind of moved me there was just how terrible the macro backdrop was. So as a huge fan of Ray Dalio and his whole thesis around gold, and the QE that just, from the 2008, 2009 crisis, it just seemed like there was nothing that was making this disaster of a financial situation that was going away. So I was trying to understand what is the thing that's going to make this market unravel. And whenever I first heard about Bitcoin and it having a fixed number of units to it, it immediately was just like, okay, so this is digital gold. And not only is it digital gold, but it's way more divisible. You could, send it to another person with a smartphone at these really minuscule amounts. So all of it just really kind of made a whole lot of sense. And then I read, this is right when Paul, is it Vigney, the Wall Street Journal, he wrote the book, oh Lordy, it came out in 2015.
That one sounds familiar.
It was a really big book. I can't remember the name of it.
That's funny.
It's over on my shelf there somewhere. But anyway, he came out with his book. I read this book and I was immediately like, The Age of Cryptocurrency is the name of it. I read this book and I was like, wow, this is nuts. Like, this is nuts. In fact, Stig and I did a podcast episode about his book back in 2015. This was probably like our 20th show or somewhere around in there, I'd say.
I was in the heart of the bear market too.
Yeah, it was. I mean, my first buy was $220. I remember very well.
Ooh.
Yeah. And, but yeah, so I didn't realize that we were in this big bear market. I knew the price had gone to 1,000, but I was looking at it more from a fundamental standpoint of like, hey, the addressable market cap on this thing is anywhere from $1 trillion to 10 trillion. At that point in time would have been my, the way I was looking at it. And this thing is...
Yeah, your framing was gold. Yeah.
Yeah, my framing was gold. And I was just like, hey, this thing could go over $1 trillion. I have no idea when that could happen, but based on all the actions by central bankers, and this could be really something big. And especially after reading Paul's book, I was just like, wow, because it gets into a little bit of like smart contracts and that kind of stuff. Then, so I took not a big position, $10,000 at the time or something like that. And then I was watching Real Vision, and Trace Mayer was on Real Vision. This is still probably like early to mid 2015. Yeah. And Trace was talking about network effects, and he started just going into his, I'm sure most people are real familiar with his diatribe about network effects. And he was just going by the numbers. And I'm sitting there watching this video and I'm like, my God, this thing is going to be crazy. And so then I bought
that 7 network effects thing that he would break down.
Yes.
That was such a brilliant framing, like early on in the space, because you would just be like, oh shit, like, no, yeah, it's gonna loop all the way back around and it's just gonna keep going.
Yes. And he would also talk a lot about game theory, which I had read a lot of books on game theory, and or books that kind of cover game theory. And so for me right there, I was just like, oh my God. And so I took a decent position there by like the middle of 2015. So what I struggled with is we got into the summer of 2017, the whole fork with Bitcoin Cash and the Bitcoin we know today was a very scary event for me. I relied on people like Adam Back and others who were, in my opinion, the real engineers, Nick Szabo and some of those guys who, in my opinion, were the smartest people in the world and that had been trying to do it for decades. And, you know, I don't think if I went back in that point in time, I didn't fully understand why I had the opinion that I had. I just knew that those people that I really admired and felt like they were the real engineers in the room, that they were looking at the security. And I think if you'd go back into some of my Twitter posts back in 2017, you'd see I was talking about how the security and the scaling in the long term, you're not going to achieve it with the Bitcoin Cash fork. I understood that, but I was taking my cueing from those people. And as the price continued to run, the traditional finance type mindset that I obviously was geared for very early on and where my roots really were telling me like, this thing's not going to go to 1 million right now. Right. Like that's what everything like deep down inside me was like, this thing might go to 1 million, but it ain't going to 1 million right now. Because when you'd look around, like, and you'd talk to your family, friends, just anybody, no one knew anything about it at that point.
Yeah. They barely had heard about it on like TV or something. It's like, so CNBC was talking about how it's gone absolutely batshit lately.
Yeah. And you didn't have,
I think Katy Perry like, painted it on her fingers.
You didn't have like the infrastructure that you have now. Like at that point in time, I was like, there's no way I'm going to go to a store with my hardware wallet, with my, ledger or whatever. I think I had a Keep key at the time. I'm not going to go there with my Keep key and plug it in or whatever. Like you just knew that like it wasn't going to, like there needed to be more people that had to keep showing up in droves in order for that price to keep running. So I was just desperately searching for some type of quantitative evidence for when I needed to really kind of reduce my position size. And so Trace again started, this was in the fall of 17. I kind of remember he wrote this article that was trying to say, hey, this price is a little rich, and this is a price that is really priced to perform. And he was just taking a ratio of the price compared to the 200-day moving average. And so in his article,
it was like 2.5 times or something.
Yeah, exactly. And so at the time he was, he only had like 7 data points on the article that he wrote. He was like, here's one spot back in 2015 when the price was 0.5 compared to the 200-day moving average. Here was a spot back and like literally only 7 data points. And I was like, oh, okay, well, let me go back for the last 7 years or however much data we had at that point. And let me just calculate what this is for every single day that the price has been available, right? And then I just plotted it out, and then I did a statistical analysis of like, hey, what's 3 standard deviations? Now the data was not normal data, so to do 3 standard deviations, all your stats people will wig out, but I don't look at things very academically. I look at them in a very practical kind of way. And I was like, okay, it's not normal data, but it's close enough. And this was 3 standard deviations to the left. This is 3 standard deviations to the right. And based on this, I think we got up to a 3.5 on that multiple. And yeah, in late 2017. And based on the stats that I had run, that had only happened 2 times in the history of the price action. And so this is when the price was around 18,000 and we hit this 3.5 on that multiple. And I was looking at the 2 other times that had happened, and the 2 other times that had happened, the price cooled off for like a year after it hit that multiple.
Yeah.
So I had made a lot of money at that point, especially at that point in my life. That was a lot of money that I had made. And I was like, all right, well, I'm going to sell this. And I should have, if I had to go back and do the trade over again, I would have done it differently, but my performance would have been worse than what I did. So
interesting.
Not too many people would probably tell you that. If I had to go back and do the trade again, I wouldn't have sold the entire position like all at once. And that's pretty much what I did. Within a couple days, I had literally sold my entire position. If I had to go back and do it over again, I would have been using like the MACD. I would have slowly, gradually stepped out of it, probably over a month or 3 months or some time frame like that. It would have been much more logical. But you live and learn, and I've learned through much smaller trades since that period of time that probably wasn't the smartest way to do it, even though I absolutely murdered the trade. I mean, murdered the trade. In fact, Pierre Rochard can actually attest to this. When I sold the entire position, I DM'd him on Twitter and we were talking on text. And I just told him, I said, dude, I just sold my entire position. He didn't talk to me. He didn't even reply. But
Silence.
But yeah, he was. I think he was like, well, you're a loser.
You never get rid of the corn.
But I told him, I said, hey, I sold the position and I'm probably going to be back in a year from now because, based on the data had suggested that when these kind of prices got hit, that it cools off for a year. And so sure enough, the multiple again, and the Mayer multiple is what we kind of call it. It got down to like a 0.4. I want to say it was like a 0.45 or like a 0.47 there in late, what would it have been? 2018, late 2018, early 2019 timeframe. It got down to that. And, I went back on Twitter. I said, hey, Bitcoin's looking pretty sexy right now. I just reestablished a position again. And I shot Pierre. I think Pierre was the first person I shot a note to. Hey, I just repurchased my Bitcoin position and I'm ready to rock and roll again. I think this thing's going to, start screaming back. And him and Michael had me on their show within a couple months after that, or into the summer of 18. And, I was ready for this thing to really start ripping again. And sure enough, it did. And this was before the whole Plan B thing really kind of came out. And so when his model came out, because what did that come out in the late 2018 timeframe?
I was about to say, it's not that old. It's crazy how widespread it became so quickly.
Yeah. But when his model came out, it immediately just clicked for me. I was like, wow, this is exactly what's going on. And because the one thing that I would say that I think gives me an advantage of being a business owner is I like to look at the mining operations from a business lens. I like to say, okay, if I was a miner, which I'm not, if I was a miner, how would I be playing this? And how would I be thinking about all the CapEx that I've got to deal with in order to remain competitive in a hardware market that the new entrant has an advantage over the person who had the older hardware? And so when I'm thinking of it from that lens, and I'm looking at Plan B's model, I'm saying this is what's setting the floor. Because for years, it's just baffled me how we're able to see this Metcalfe's Law price chart in something that's free and openly traded. Like, right. So like when you look at the price chart, and this would drive me crazy. And then whenever I saw Plan B's model, it really started to like solidify my opinions on what's going on. And so I guess for me, looking at price charts of all these other equities and things that I've invested in through the years, and then I look at the Bitcoin price chart on a log scale, and it's like this perfectly shaped Metcalfe's law like price chart, which makes no sense when you take a step back and think about how can something like that occur in a market that's just free and open for anybody to buy and sell it. Mm-hmm. And so the conclusion that I've come to, I don't know if it's right, but this is where I stand on it, is that the miners are setting a floor. They're setting a price floor, and that 2-week difficulty adjustment combined with the four-year halving, those two functions inside the protocol working together are supplying this floor to the price action. I would argue that floor that was penetrated and broke back in the March COVID meltdown. Yeah. Mm-hmm. But because, and the reason why I would say it was penetrated is because so many derivatives blew up, so much fiat and credit that was built on top of the really small fiat baseline that actually exists. All that fiat and credit that's constructed, the promises that are constructed on top of that, blew up all at the same time, which caused that price, when you think about the number of fixed units, and I'm saying fixed with quotes here, because we all know it's still being increased a little bit, but the fixed units of Bitcoin, when you compare it to this really flexible currency supply, because of all the promises built on top of it, as that collapsed in a very short amount of time, I think that's why you saw the floor get penetrated for just like a really small period of time. But then as a central banker stepped in, they provide massive amounts of liquidity to replace.
They did that in one way.
Yeah, they did it in a just a massive way. They replaced all those promises that had blown up, and immediately you saw the Bitcoin price recover back to that stock to flow, or I would call it a production cost, almost immediately. And what I found fascinating is his model was almost down to the dollar on the day of the halving event, which changed the whole new issuance. And so
man, the stock to flow, the whole, like the idea that you can see a Metcalfe curve on that log chart.
It's nuts.
Is absolutely insane. But when you stop to think about money because it's not a productive good, it's a community good. It behaves much more like a language than an actual like product in the market does. And because of that, like you actually begin to see that like something like that actually could occur, and that it would be related to its actual supply, like the existence of it as a valuable asset. And what's funny, like you bring up March, because I think it's like American HODL like said something about it today on Twitter, because like we're at the 1-year anniversary now, and it was so funny because like I know like a bunch of people like kind of freaked out for a bit, like what the hell is going on, and I did too for like 30 minutes, an hour or something like that. I was searching, I was like major hack, SHA-256 broken. Like I was like just searching through Google, like anything that I could possibly find. And there was like nothing. And I was like, so wait a second, this is just like a huge liquidity crisis. Like people need a liquid asset to dump because we've just got a deflationary shock in the dollar right now. And so the price has plummeted. And I immediately, like, it was like you just flip a switch. I went from like scared to just like panicked, excited. And I went through and we have like these little boxes that are like kind of our filing cabinet things. So like all of our papers and stuff. And I just yanked them all out of our shelving unit and just started dumping out old papers, looking for any dollars anywhere that I had. And sure enough, I found an old retirement account that I had at a job that I'd paid into, and the employer had matched for like 3 or 4 years or whatever. I had never done anything with. And I was like, shit, yeah. And I cashed that shit out in like 2 or 3 days. And like, you're going to pay taxes on this. Like, I don't give a shit. Have you seen the price of Bitcoin?
Yeah, no doubt. I was recording an interview with Nathaniel Whitmore. And as the price went down, this is during the March event, the price went down through like, if it kissed like 4,000, maybe just a touch below it. And we were recording and we were talking about it then. And I distinctly remember there was a tweet that really resonated with what was happening, which is before a tsunami hits the beach, the tide completely gets sucked out and there's just sand everywhere. And for people who don't understand what's happening, they're standing there looking around like, what the hell just happened, right? But for anybody who knows what that means,
look at the starfish.
It means there's a massive wave that's inbound. And so that event for me, and people can go back and listen to the conversation because I was describing exactly what I'm going to tell you right now. The event for me was a really obvious situation where the water had just been completely sucked out and the response was going to be 5x what was sucked out. And so that night and the subsequent days, I had a very similar reaction to you where, I mean, I'll just tell you, I pulled a Michael Saylor from my company at that moment in time. I said, this is going to be unprecedented what happens next. And, it was a hard decision, but just because I really dislike being in a binary kind of mindset as far as, especially when it comes to investing. But at that point in time, for me, it was such a unique situation, especially for the price and where I kind of suspected the prices would be in a year from then, which, I was thinking we were back then. I would have told you, I would have thought we would have been around like 25 to 30,000 at this point this year.
Yeah, we were there for like a day or two.
We were there too. But so I mean, I took just a massive position at that point in time, and and luckily it was correct, but crazy times. I mean, we are in unprecedented markets. This is nuts.
Speaking of unprecedented markets, the macro situation just seems like just fake.
Yeah.
Like it doesn't seem possible that we are in the financial situation that we are in. It seems so batshit.
The world's in denial for sure.
I mean, I just, there's like what, $20 trillion of negative yielding now?
Yeah.
If I'm not mistaken. And this is what gets me with like looking at Bitcoin is that I can't help but look back and see, cause I've been like through 3 of these cycles now. And so I'm like, all right, so we're going to do it again. We'll go up to 200, 300,000 or something, and we'll come back down to 70 and everybody will freak out and it's dead and it'll balance out around 120. I can easily see that narrative happen all again. It's familiar and comfortable at this point. But I can't help but wonder if it won't, because like back in 2017, when that happens, like you kind of have this position where you're talking about like the infrastructure, the real foundation of like a market interest rate, like futures markets, that kind of stable base to actually build a financial system on top of it was not at all there, right? Like it was just, Bitcoin was still a baby. And Bitcoin is not kind of now coming into its own, and in a way that it could actually soak up an astronomical amount of this value. And in 2017, I wasn't going, oh, well, in 2019, it's not like the dollar is going to be gone. Like that market's not going anywhere. But now I just see like, what choice do they have? What choice do they have but print another $2 trillion in 3 months? When does that, is there any end game to this?
So I'm with you 100%. I think that the thing that's going to surprise a lot of folks in the coming quarter to coming 2 quarters is you already have these signs of inflation coming back into the market. And that's even with their CPI gauge, which is totally cooked to demonstrate no inflation. So even with this just total fake gauge for measuring inflation, you're starting to see numbers, and really the oil market for me is such a huge indicator of what's to come. And
yeah, it just crossed all time. It just crossed the high from like last couple of years, right?
Yeah, you're at $65 a barrel right now,
okay.
And it would not surprise me in the least bit to see oil go to $100 a barrel by summer. And people hearing that would be like, that's ludicrous. I've been saying this since back in the March event. I was saying we're going to see the lowest oil prices ever, and then a year and a half later, you're going to see some of the highest oil prices you've ever seen. And so here it comes, right? This is this narrative of inflation coming back, and where I think the icing on the cake for this is they just pumped out, what was it, 1.7 trillion in UBI checks.
Mm-hmm.
Okay. So now think about that. Every person's going to get these checks. They're then going to have some spending money for a little bit. They're probably going to have to do it again. And so these implications of everything coming back online in a fury, along with the UBI checks, along with the QE that's probably going to have to accompany it in order to keep interest rates down, even though the inflation gauge is going up, is going to just be a sight that I don't think most people are ready to comprehend. So
yeah, the inflation that will come when they quote unquote flip the switch back on. I don't think anybody's like really anticipating, like they don't get how quickly it can work against us because everything's been static. It's almost like the lockdowns are necessary to prevent the flood, you know? So it's just
right.
Absolutely nuts.
You're right. And I find a lot of people miss is if you start doing this UBI a lot, and it seems like that's the direction that this is going to go. Let's just say they start doing the UBI checks every quarter. That spending is going to find itself into these metrics that they do use for CPI. The bond market naturally is going to want to sell off, which makes the yields go up. But the central bankers just cannot allow the yields to go up. So then they're going to have to step into the market and buy and provide a backstop to that yield that's trying to come up. And so then you're in this game where you're not just doing QE, you're doing UBI simultaneously, and they're incongruent with each other, where the UBI is trying to push the CPI gauge up, and they have to respond in kind with more QE in order to not allow the interest rates to go up, because if they do, the price of everybody's home, their ability to issue more debt into the market as a sovereign nation, like all of those things unravel with each other. And so that's what I suspect by midsummer is going to be the thing that when you turn on CNBC, everyone's gonna be like, oh my God, what in the world is happening right now? This is nuts. And there's Bitcoin, right? There's Bitcoin, the thing that can't be manipulated with a fixed supply, just soaking it all in.
Yeah. So treasury yields just spiked. Like we've recently had a spike in the interest. And what do you think that is? Why now? Is this just because things are starting to open back up?
It's the inflation. Yeah. So your fixed income investors are looking at this and saying, wow, look at the price of oil. Look at the price of this. Look at the price of that. These things that are actually in the CPI gauge. And they're saying, if inflation's now this, if my expectation for inflation is 1.5%, well, if I'm owning this bond and it's less than 1.5%, I am losing money. And so they're selling that bond position because they don't want to be in that, or they're guaranteed to get wrecked. So they're selling out of it, and that's what's causing the yields to go up. But unfortunately for the Fed is they can't let the yields go too high, or then the price of everything starts getting crushed.
Okay, so basically they're becoming aware of what should have been obvious, if you're following Chapwood or the Shadow Stats or anything like that, is that the real yield on those bonds is garbage right now.
Total garbage. I would tell you, I think the Chapwood index is still low. I think that the real inflation number is higher than that. Yeah. Because what they're not accounting for, like any gauge or any basket that you're using in order to measure inflation, there's things that aren't in the basket. And so like Lynn Alden, like Michael Saylor, I completely buy into the idea that your M2 is your inflation rate.
Yeah.
It doesn't make sense that it could be anything other than that, because if you're supplying, and I use this example quite a bit now on many shows to kind of explain things, but if we were playing a game of Monopoly and the banker is inflating the money supply on the board by 5%, they're increasing the money supply by 5%. Well, the inflation of everything on the board is increased by 5%, right? Whether it's going into a service, whether it's going into the value of Park Place, whether it's everything on the board, the whole economy in there is inflating by that rise in the supply of money. So why would a bigger scenario with a lot more variables be any different? In my opinion, it's not. You're seeing those prices going up, but it's just not in things that are in the basket.
Yeah. Yeah. And like you realize too, like the way the economy moves is there has to be some sort of a trade for a price adjustment to move from one industry or from one area or product or, factor of production or something to another. So if you're looking at inflation that gets dumped into like equity markets and done in treasuries and corporate bonds and stuff like that, but it stays there. But you don't have any velocity of money. You don't have any movement between the layers. Well, then what you're actually looking at is like the fact that they took out a loan at near zero interest rate and then bought back their stock. That is the inflation rate. The point is that it's in things, they specifically measure it in consumer goods because it's cheap crap that doesn't last very long. And it's nothing that anybody stores for any length of time. But the house that they wanted to buy goes up by 20%. The education they need to buy goes up by 30%. Their healthcare, their everything that matters, everything that's significantly valuable and is going to last for 20 or 30 years, investing in a productive enterprise and actually getting a freaking retirement as opposed to dying on this sad, pathetic Social Security. Like those things, the really valuable, meaningful things have skyrocketed in price. You can't retire on a bond. What the hell? You have to have like $50 million to make 10 grand. It's absolute shit.
Negative 10 grand.
To make negative 10 grand. Do you think we'll see negative interest rates? Like in the US? I mean, is that inevitability at this point?
I think at this point, it really comes down to how fast all this plays out. I mean, you're already seeing them internationally. Would they try to do it here? Absolutely, they would try to do it here. But it depends on how fast the overall market participants figure out what the escape hatch is. And we know what the escape hatch is.
Yeah, yeah.
So could we get there? Absolutely. Will we? I don't know, because it really comes down to how fast people figure things out as to how this is all going to unravel.
So that leads me to, I was talking about this in yesterday's Guys Take episode. This is actually what I ended it on, was the establishment. Oh, actually, we can get into Contango real quick, but I'll hit this. Maybe we'll circle back to it. But the establishment of interest rates in the Bitcoin market, and more importantly, interest rates, they're real. Yeah. They're actual market interest rates that we haven't had for 50 years. Like, I mean, like we haven't had an actual market in the price of time in ages. Now it happens to be in a monetizing asset. So the volatility and the, like you say, the rush, like when the tsunami, goes out, the massive rush of capital from, between the two is going to throw everything into a bit of chaos. But nonetheless, this thing can actually respond to it, which means it's actually going to allocate capital properly. And I think that's going to mean that the financial system, as it gets built out on top of Bitcoin, is going to be so much more accurate and better at economic calculation that, like, I just don't see how after the foundation of this thing matures to $3, 4, 5 trillion that it just doesn't keep going. You know, like
I'm with you. I think that there is a very real possibility that it does keep going. And I've said for more than a year now that the stuff that I did back in 2017, I will not be doing on this cycle.
Okay.
I won't.
I was actually going to ask you specifically that because I think I'd heard you say that, but I wasn't sure.
No, I will not be doing those types of things on this cycle just because of what you just described. In talking with a lot of people, especially newer investors or people that have only been in Bitcoin and never really participated in traditional financial markets, especially equity valuations, the thing that I think most don't really understand is that your interest rates are kind of like the keystone of everything in the economy. So like that 10-year treasury that we were talking about earlier. In this traditional system, that's the thing that's driving the prices of literally everything. Over in this new crypto economy that's being constructed right next to the traditional financial system, you have real cost of capital. You have real interest rates, and they're sky high. They're 10% for US dollar. They're 20% for US dollar and peer-to-peer. 16%, I think, is what the number is. But over here in the traditional system, we're led to believe that that free and open market interest rate is 1.5% right now. But we know darn well they've globally printed, I think the number's around $30 trillion since the 2008 crisis. There's been about $30 trillion of printing that has taken place, and all of it has been stuffed straight in. Well, not all of it as of the last year, but most of all of it has been printed and stuffed straight into the fixed income bond market, driving the prices sky high and the yields down to these yields that we see right now. So if the cost of capital to go out and borrow and price everything is based off of those rates, a premium to those risk-free, quote unquote, risk-free rates, what happens is your valuations that everyone's doing for a stock, you name it, Apple stock, I don't care what the stock is, the price of real estate, everything comes back to what's the interest, what's that interest rate, what's that risk-free rate, and then what's the premium on top of it. And so when you talk about economic calculation, the equation, if you really want to use the most basic equation possible for economic calculation, your present value that you're estimating something's worth today is equal to the up in the numerator is your future free cash flows divided by a discount rate. That discount rate is based all around those risk-free rates and then whatever premium you're attaching on top of them. Okay. So as those risk-free rates get pushed lower and lower and lower, and the fact that it's in the denominator of the equation, that makes your present value go higher and higher and higher. So if those rates are not 1.5, but they're 5%, 10%, 15%, guess what happens to that present value? It gets obliterated down, right? It goes down, and it goes down in a horrific fashion, like fast. So one of the main reasons I keep talking about all these interest rates that are happening over in this new financial system that's being constructed is because when I see these rates and where they're at right now, if the market starts to say, hey, that's the real risk-free rate, not this 1% or 1.5% or negative percent that I'm being force-fed down my throat, the price of literally everything on the planet gets reassessed, reevaluated, repriced at a level that, in my humble opinion, let's just say the rate's 10% that the market then comes to. That compared to where we're at today is an adjustment of 70, 80% from the market caps you're seeing in the economy right now. So if you've got a company that's $100 million valuation, it now becomes a $20 million, or what did I say, 100 billion? If it was $100 billion, now it's 20 or $30 billion valuation. And if that's a stock and it was 100, now it's 20 or 30. That's a devastating event for people. So that's why I think it's so important to understand, A, what's the real inflation rate? B, what's the real cost of capital and what's the premium that it's getting bid above that inflation rate? And 3, where the hell am I finding a free and open market that's providing me one of these rates today?
Yeah. How do I have any sort of legitimate rate to go by?
That's right.
And that's been the problem. There's basically been no escape valve to give a real sense of what the pressure that's been built up here is.
Yeah.
And this leads us to, let's talk about the contango thing.
Well, one final thing that I'll say, Guy.
Yeah.
People who would listen to my show from years ago, they're saying, Preston, you're becoming mean, or you're becoming angry, right? You know what it is? I am so sick and tired of listening to these quote unquote experts, especially the ones out of academia, that act like we are seeing free and open markets and free and open cost of capital for the valuation of everything in the world right now. I'm sick of it.
Where?
I'm sick of it. I'm tired of living in this fantasy land where people act like we have free and open markets when we have nothing of the sort. And
it's not even a grain of sand on that beach that is free and open market. Like, it's nothing. That's what just blows my mind.
And I'm at the point,
just keep goes on. Yeah.
I'm at the point now where I just want to point at each one of these quote unquote experts, and I just want to scream, liar. You're a liar. And what you're doing is, I don't know if you don't understand what it is you're doing, but you are the root cause of the lack of critical thinking that has got us to this point in time where what you're trying to promote as being normal is nothing of the sort. And I'm sick of it. I'm done. I'm like totally sick of it. And that's why I'm screaming from the mountaintops. How do you measure inflation? What is inflation? Like, what is the cost of capital?
What it is, why it's important, and what you think we're actually looking at, right?
Yes.
You're going to have to define your denominator, because what the fuck? Shit ain't working with CPI. So let's get into this contango thing. So this is something that I've read about in a couple of pieces that mentioned it, and I know you've brought it up on a lot of shows. This has been kind of the thing. I see hashtag contango all the time, like on Twitter and shit.
It's become a meme, yes.
It has become a meme. What is this? How does this the idea here is that this is a feedback loop for the kind of the establishment of financial markets and futures markets in Bitcoin that gives an incredibly good, essentially risk-free return, while at the same time locking up Bitcoin and therefore lowering the liquidity in the actual buy markets and pushing the price up, which funnels the whole process to happen again. But what is it exactly? Break it down. Like, I have no idea.
So I would first describe it. Let's use oil as an example to kind of describe what's going on. So similar to what we saw with COVID. So everyone who's an oil manufacturer sees the writing on the wall. All right, we've got to slow down production because we just can't continue to produce at the levels we were producing before, because there's going to be a reduction of 80% in the amount of cars on the road and all that kind of stuff. So the problem in the oil market is for them to make an adjustment to the supply and demand. It's not a quick process. And more importantly, when they do turn off those rigs that are harvesting the oil, it's a slow process to get it turned back on. It's an expensive process to get it turned back on. But in general, a lot of the supply and demand is kind of predictive. Like, they have a very good idea of like what that demand flow is going to look like. And COVID was one of the first times in history that you had such a monumental shock to the system as to the amount of supply and demand that was going to be there. So the demand disappears. The supply is still producing at a pretty high level. And so this produces a situation where there's this oversupply being supplied into the market because of the time that it takes for them to turn things off and whatnot. Okay. Now, what happens to the price when you think about how that's going to impact the storage? So you only have so much storage that can hold this oil that's being supplied, that's coming off, because it's got this lag effect to it. And so what will happen sometimes in the markets is, and I'm not necessarily describing the event that we just saw, but what will happen sometimes in the market when there's this oversupply is the storage will start getting filled up. And the people, if you own one of these storage facilities and it's filling up really quickly, what do you do to the price of your storage? You start bidding the price, saying, hey, it was $100 to store it here last month, but now it's $200 because I know you can't put it anywhere else. And I know it's still coming out of the, it's still going to be delivered on schedule, and you can see what that schedule is, right? So what happens is in the futures market, that price to store the oil starts getting bid into the future curve. So your spot, let's say your spot's $50. What happens in this contango is maybe next month it's not trading for $50. It's trading for $51 or $52. There's a premium that's getting bid into the future price, even though there's all this uncertainty and things like that, because the cost of storage is now getting bid into
added to the mix
of that price into the future. And so the bigger the shock, then you add in the even to make it even more confusing. If people feel like the price is going to move faster, like the price is going to go up faster than what it is, well, then there's reasons to maybe buy a future price higher or lower than the spot, and all those kind of things get factored in. But in general, that's one of the key ingredients that I would tell you is the cost of storage getting bid into the future price. And so, like, why would somebody buy a futures contract 3 months from now that's higher than the current spot price? Well, if they're expecting the cost to store it to be really high, higher than what they would pay when they actually need it 3 months from now, they're willing to pay a higher price to ensure that they can lock in that $53 price because they don't have the storage capacity or whatever, and they actually need it 3 months from now, not right now. Okay. Mm-hmm. So that's why you see a contango occur in the market. Let me preface this. I'm not an expert at futures. I am not an expert at derivatives. Okay. I understand them a little bit, enough to probably get myself in trouble. But there's people out there that are way smarter on this stuff than me. I will preface that. So the thing that makes the Bitcoin contango so strange to me is there's no cost to store it for the most part in general. Like if you're going to store
there's key management risk.
There's key management.
That's it though.
But like if you're going to store $100 million worth of Bitcoin, like your cost to store that
is meaningless in the context of $100 million.
Yeah, it's meaningless compared to $100 million. And it's really meaningless if I have to store it for 1 month versus 5 months. It's like totally laughable.
That's the same.
So then the question becomes, well, if there's really no storage cost, it's not like it's gold or anything. Like it's really easy to do this. You can accept immediate settlement. It's not like I have to have it delivered to me 4 months from now because I can't store it myself right now. Like none of those things exist with Bitcoin. And so my immediate question is, why the hell is there a contango? Right. And I don't know that I really have a good answer for you. Yeah. Okay. There's a couple theories that I kind of have around this. One of them is that if you're not allowed to own Bitcoin, but you're allowed to own a contract, maybe that's why you own a futures contract and into a certain date in the future. So that's one theory of why maybe there's structural limitations.
Kind of like a regulatory arbitrage.
Yes, there's a regulatory arbitrage situation that are forcing people to go out further out in the curve, and they're bidding a future price that's higher than the spot. Another thing that I had heard from somebody is that on some of these exchanges that allow you to go into a very deep levered position, they're able to do this in the futures curve, but they're not necessarily able to do it in the spot. But in general, the trade exists. Okay. Why? I would throw it out to your audience, and I'm sure you're going to get some awesome feedback as to the why. And I've tried. I just don't necessarily feel like I've got a warm and fuzzy response from people as to why it continues to persist and why it's there. But if you go out, and this is what Plan B talks about, of locking in a 10, and I think it's been as high as 20% risk-free trade, they're going out, they're buying the spot at, call it 50,000, and then they turn around and they write a futures contract for 3 or 4 months later at 54,000, and they immediately realize a $4,000 gain or a $2,000 gain. And when you annualize that,
they sell the contract in full, right? So they're getting the full dollar amount plus the, like, you know, if they bought it for 50,000 and then sold it for 54,000, they had 50,000. Now they have 54,000.
Yes.
Yeah.
And when you do the math and you turn it into an annualized performance, it's like 10 to 15 to 20%, depending on how much that spread is when you go to capture it. So not all markets are like this. The ones that we're seeing this trade materialize are the ones that allow the most leverage. So like these exchanges where you can go 20x leverage. These are the exchanges where you're seeing this contango trade where the spread exists. So, I mean, if you're a person with a lot of money and you're looking at this, you're saying, okay, well, this is just free bacon. And what I find really important about this is if I'm being incentivized to put on this risk-free trade, when I write that contract, what I'm doing is I'm locking up a Bitcoin for a future date's delivery. Okay. Which means there's Bitcoin that's being clawed off the market. As long as this contango continues to exist, there's Bitcoin that's being clawed off the market, put in a storage compartment, you know, locked up, and it doesn't come back on the market for it's not being sold if it's not back on the market, which drives price higher. If the contango would disappear, well, then this whole thing falls apart. Like this whole locking up coins and that driving the price, it falls apart. But so far it hasn't. It just continues to persist. Now, where this gets even more interesting is, so that's part one. Part two is now you have this borrowing and lending market.
All right, let's take a quick break for our sponsor. That is Shift Crypto, and they have the BitBox O2 hardware wallet. Not your keys, not your coins is the most important rule in Bitcoin, and the best way is to secure your keys with a hardware wallet. The BitBox O2 has a Bitcoin-only edition. It's a sleek little device, and it is very simple to set up and use. I've been using their default desktop app for a long time, and it's really easy. It is a Bitcoin wallet and nothing else, which is a key part of lowering the attack surface of the device and removing any potential unnecessary complexity. It runs fully open source firmware with deterministic builds, which just means that you can fully verify the firmware being run on your device. There's support from a lot of great wallets and full node implementations. It lets you connect to your own full node. It has coin control, can connect directly over Tor, and for better efficiency, it supports the newer Betch32 addresses. Check out the full list of comparisons by going to the page at GuySwan, and that's with 2Ns.com/bitbox, for how it breaks down against the other popular hardware wallets in the space. And don't forget to use the discount code GUY, G-U-Y, for 5% off. Again, that is at GuySwan.com/bitbox.
More interesting is, so that's part one. Part two is now you have this borrowing and lending market. So let's say I have 2 Bitcoin and the price of 2 Bitcoins $100,000, and I want to borrow 1 Bitcoin worth of $50,000. So I go to a company like BlockFi or wherever, I go peer-to-peer lending on HODL or you name it, right? And I lock up 2 Bitcoin. I get 1 Bitcoin's worth of value back. I then go into this contango trade. I get my 10% premium. I go back, I repay my loan, and I get my 2 Bitcoin back. Yeah. But during that process of what I just described, I locked up 2 Bitcoin.
Yeah.
So in both sides, I'm locking up Bitcoin in order to do these trades, which means I'm putting less and less Bitcoin onto the market for selling. And I think that I would really like to have a person with a lot of experience in derivatives.
Break that down,
pick it apart, or shoot holes through it, or just say, "Hey, cool story, bro." But but to date, I really haven't had somebody that's been able to really kind of pick it apart. Now, when I think about, okay, so what's the real impact on the price, and like how many people are doing this relative to the amount that would actually move the market or try to continue to propel it upwards, I don't know what that number is. I don't know what that percent is or what that ratio would be relative to the power of, call it the halving cycle. I suspect it's way less, right? Way less potent or less powerful. But maybe it is. I don't know. Somebody needs to run the numbers on it and do the math, because I'm not going to.
Yeah. The futures markets are getting crazy though. Volumes have been absolutely nuts. The Canada's ETF that launched broke records for Bitcoin. They did like $80 million worth in the first hour. And then they hit the second day, it did 3 times as many as any ETF on the entire market. The second day. Like the fervor around the financialization of Bitcoin right now is just kind of just impressive, like every which way you look at it. And I think we'll probably get an ETF really soon, because they'll capitulate and just, finally do that, which isn't really a big deal, because basically everybody's worked around it now since 2017. It all kind of fizzled out. But one thing that's really interesting as this market gets more and more liquidity, as there are real interest rates and serious plays that people with $100 million, $1 billion can actually participate in, is what does this do for the treasury markets? And more specifically, what does it do for the Fed's ability to actually keep interest rates low artificially?
This is the question. This is the most important question of all questions, in my humble opinion, of what you just asked. Okay? Because it goes back to what we were saying earlier. You got these 2 economies. You have these 2 financial systems that are now side by side. They're constructed. One's massive in size. The other one is much smaller, but has the capacity to take the whole thing on.
Yeah.
Okay. And that's the important part, is it has the capacity to just devour and eat the entire other system. And the spreads that I'm seeing from
drink that milkshake.
Drink it. Yeah. And when you're looking at the rates between these 2, we're not talking about something that's a percent difference.
Yeah.
Right. So when you think about, I go back to like fluid dynamics and engineering. And when you think about something that's not only sucking and the other one is pushing at the same time, and the delta between that pressure vacuum is astronomical. 10% in fixed income, you might as well literally have a different universe. Like you are literally, and you know what? That fits with the analogy of a black hole, is like, maybe you're going from one universe, it's getting sucked through a pinhole, and then it's getting blown out into another universe. And that's why it looks the way that it looks on the charts, is because that's effectively what's happening. Because how in the world can you convince somebody who's buying contracts that guarantee the loss of their buying power to keep holding that, when over here you can get a 10% return?
Yeah.
It doesn't make any sense.
And even the time comparison between the 2, like I'm going to buy a 10-year bond, it just, Like what's
this is an overnight. This is an
what
overnight.
the hell is safe in 10 years?
This is an overnight rate that we're talking about. Great point.
And the thing is that the only reason the Fed can keep the rates artificially low is because they have just enough of that gap to pump back into the market to make the selling pressure go away, to make the buyers like calm back down, okay, let me look at this again, because comparatively it starts to make more sense with all the legacy, with all the fiat metrics. But when there's a real metric to compare it to, when there's a real market price, and they begin to see Bitcoin as legitimate, and a place that a billionaire can put their funds and actually make a sustainable low risk return, how does the Fed coming in and buying and like correcting for the fall in buyers or the increase in sellers, how does that fix the problem?
Oh, it doesn't.
That doesn't fix the problem anymore. It's the only reason it ever worked is because there was no escape valve. There was no exit door to the system. And now there is, and it's big enough to fit a bunch of fat cats through it. And the whole floor.
And there's no off switch.
Underneath that thing. There was, you were going to get an off switch. Nigeria banned it like a couple of months ago. And Nigeria is now per capita the highest adoption rate in the world.
Congratulations. You just shot yourself in the foot.
It just seems so crazy that like this could legitimately, and when they're in the exact same position where they're basically in permanent UBI. I don't see how they turn that thing off.
No.
And like when you have those two things standing against each other and an exit door at the exact same time, I can't help but, I mean, obviously it makes much more sense and it's much more reasonable and practical for me to go, yeah, we'll go through another cycle. There will be a big shitstorm and, there will be a crash, blah, 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 like no hyper Bitcoinization. But I honestly, it would make me go, wow, it's a little bit surprising, to be perfectly honest, that we end up going through another cycle.
Well, maybe what happens, because your array of potential outcomes is endless. So maybe what you see, maybe what you see is a 6-month correction, only for it to pick back up again and start taking off completely out of sequence of this halving cycle like we're accustomed to. Maybe it's 3 months. Maybe it's this big, giant 3-month correction. And then out of nowhere,
do a 2013-14 thing again.
Yeah, maybe then it just picks up and just goes crazy, right? So I'm not convinced that trying to time a top here is the smartest play.
Is a good idea.
No, I don't think it's a good idea.
I'm kind of right there with you on that one. I've thought about it a lot, and I thought, I'll at the top of the next run, I'll cash one out and pay off my house or something like that, and just be debt free and all that good stuff. But now I'm just like, just hang on to the debt.
I mean,
it's not going to be worth shit.
Yeah, you're gonna get that for free.
Yeah,
in relative terms. Yeah.
Yeah, and the other interesting thing is that a lot of people talk about the comparison with gold, because that narrative's real easy. Store of value asset, digital gold. But then you just kind of look at the broad scope of things.
This has not, I'm sorry. That argument for me is just like so laughable.
It's just kind of like, I don't know. It's the tricycle to the Mack truck. It's just not the important thing that's happening here. And you look around and see how many things have developed a monetary premium. And there are so many. Like the money is just crap. Like going back to the example of like when inflation dumps into the things that you care about and you want and that are valuable and that you want to have long term, or that you retire on, or that you live in. Look at those things and the monetary premiums they have developed over the last 10 years. Those monetary premiums will be soaked up when you have a real monetary asset to hold. And you talk about like a comparison with interest rates, is that like a corporation that's worth $100 billion. Well, if that interest rate changes drastically, suddenly it's 30 billion valuation. Like when you're talking about that comparison, That's the capital that goes to a monetary asset. That's the capital that readjusts into the hedge against uncertainty. And that's what money is, the language of an uncertain future for its community, for its economy. And all of that can flood in. And so we're looking at equities that are massively overpriced, housing that is massively overpriced. And I mean, we're already talking about like 50 to $100 trillion. And then you look at treasuries. And every single time I look at treasuries, all I can think is that if this thing actually works, if this thing sticks around, and this is a truly sound monetary asset that is stable in the sense that like the thing is reliable and it truly builds a global foundation, like financial system on top of it. Who wants to hold sovereign debt of a country? The only reason sovereign debt exists is because it was the money. Like it literally was the money when we went into a quote unquote virtual, a paper economy, because gold no longer served the purpose of actually facilitating the economic activity. It had to be a debt. So you go to the best debt, a country's debt, right? Money used to be an asset.
The only thing that I would tell you is the people that are buying it today are buying it because they're of the opinion that it's a high probability the government's going to come in and buy it at a higher price than they bought it.
Okay.
That's why they own it. And for 40 years, it's been one hell of a trade. They have continued to make money on this idea that the government's going to step in. Now that for the first 30 odd years, well, for a lot of years, the government was stepping in and they were bidding the price of the federal funds rate, which is your overnight money rate. But everything else would fall into line based off of that manipulation of the federal funds rate. The longer tail of the bond yield curve would fall into place and follow this because of the tightening that was taking place. So it's been a great trade. It's been a trade that people have made tank loads of money on, but like anything, it's run its course. And now people that are still doing this trade, I would tell you, are the dinosaurs and people who are dancing in front of a steamroller, picking up pennies. And, is the government going to come in and bid?
That's a great analogy.
Is the government going to come in and bid the price again on the 10-year treasury at some point? Absolutely. They're going to. Is it eventually going to get to a point where they're the only buyer? Probably. So when I look at things in terms of the relative gain to other opportunities, that's when it goes to your question that you had earlier, where it's going to suck every last drop out of anybody who owns these things, because like you're saying, there is no money to be made in this trade anymore. It is done.
Yeah. It's just been absolutely sucked dry. Yeah. And it's fake money too. Like it's not even a real return. It's all nominal. It's like that video that shared out on, there was like a TikTok investors video of I died laughing. I just could not stop giggling at this. And it was I looked like a husband and wife or whatever couple talking about how did you see this? Yeah.
I retweeted this thing that you sent. Yes. The guy was like,
I was fucking losing it, man.
It's crazy. Yeah. The guy was like, hey, we want to tell you about this investing thing that we're doing. And I buy it when it goes up. I buy it down here. And then as it goes up, I sell some. It was insane.
How can you lose? How can you lose?
And you know what? It's one of those important things to stick a pin in the timeline of this meltdown that we're seeing, that says a person 20 years from now would go back and watch that video and be like, how in the world could people not see what the heck was happening when they would watch videos like this? This is so obvious in hindsight. Yeah. But
it screamed to me because Nick Carter was, he was doing little clips and stuff or little screenshots or whatever from When Money Dies, which I actually haven't read in full. I'm kind of embarrassed because I've been wanting to read it and I just haven't gotten to it. But he did a little excerpt from Weimar, from the Weimar Republic when the mark started to collapse, and it was a whole section that was talking about, like, it was a description of, there was a period of time where the stock market, essentially, where stocks and everything just got crazy, and every single person was buying and selling and thought that they were just making bukus of money because the stocks were just soaring, and everybody thought they were getting rich right at the beginning of this, and they were so excited about it, and they were buying it when it was down here, and then it was going up and they were selling it, and things were wonderful for a little bit. But that was actually the period where people were just denying the fact that this was unfolding. And it just kind of scares me that this is going to be a shitstorm, you know?
Globally,
we have managed to just spread. This isn't one country. This is everything. The Euro's done this just as hard. The Japan's done it, and they've been bleeding through it for 20 years.
But think about why. So why is everybody going through it simultaneously all at the same time? Well, it all goes back to Bretton Woods. So the dollar was pegged to gold, and then everybody else was pegged to the dollar. So here we are, all in this together on a global scale as to what monetary policy was from 1944 up until the U.S. comes off the gold standard. U.S. comes off the gold standard. Well, guess what? Everybody else comes off the gold standard all simultaneously. And now we're all just having this free-floating fiat currency game. But here's how they were able to keep everything together. You had high interest rates. You had high interest rates because you basically debased the money to the point where you couldn't make good on the gold. And so, so now you're dealing with these 16% interest rates. By the time you get into the 80s, it was at 16% interest rates. Well, you can keep all this glued together as long as everybody has interest rates to play with, and you keep dropping the interest rates. Okay. So that's what they did since early 1980s until now, all around the globe. Bringing those interest rates down. Japan was the first one to bottom out, right? Now you're getting over in Europe, they're bottoming out, and now you're starting to get the U.S. and we're bottoming out. And so as we collectively get down to this 0% interest rates, now you're at a situation where everyone's like, it feels like things are breaking. It feels like the middle class is getting obliterated. It feels like, well, guess what? That's because the bankruptcy that's right. The bankruptcy that occurred on a global scale happened decades ago, and they've just slowly manipulated interest rates in order to offset the realization of that bankruptcy. And here we are. Surprise, it's arrived. And luckily for the world, we have something that's a decentralized solution that is supplying a protection of buying power to everybody collectively. Because if it wasn't being supplied collectively, I would fear for how the power vacuum would present. And I still think that we're definitely not out of the woods just because we have something like Bitcoin. But I think it's going to help assist in everybody collectively being in the same situation. A little bit like COVID, the whole world was experiencing it together. And so it was a situation that I think is going to be very similar to as Bitcoin takes root on a global scale, that as it's being supplied, everyone's kind of in the same boat. It's not like the U.S. or any one country has an advantage over the other based off of this being supplied as the solution.
Yeah. The cracks spider in so many different areas that there's no explicit direction to point to or to flow from. The whole thing is just kind of crumbling out from everybody at once. I can't help but think I kind of constantly go back between the markets are so digital, connected, and mobile today the ability to respond and shift is faster than it's ever been. So that gives me a lot of hope that the technology, I mean, this is why Bitcoin has moved at the pace that it has, right? Is that there's the barriers to get into it are literally just, you got to drink from the fire hose of what the hell is money on podcasts and YouTube videos for 5 months to just understand what you're getting a hold of. But after that, the transition is,
and that's going to go away. That's going to eventually go as the price gets to a certain point.
They won't care.
Yeah, it's going to be really obvious that, like, oh my God, I need to own this. It's not still like they're not going to try to understand anything other than everyone around me is getting loaded by buying this earlier, and it seems like it's going to replace everything because everything's melting down, and they're just going to want to own it. It's not going to matter whether they understand anything at that point. Yeah. I would say that price is anywhere from like 500,000 to maybe $2 million per Bitcoin is when that mindset is going to set in.
Do you think this cycle touches that? Like do you think we see that in 2021? Maybe. Yeah. That's kind of where I am.
Let me put it this way. I think it's more probable than most people would think.
Yeah.
I think
it's more probable than not, to be perfectly honest.
I would put it at about a 50-50.
Yeah. And that's safe. That's safe.
Which is equivalently saying, I don't know. But you hear, I know I've been on Clubhouse and I hear people say, yeah, well, in the next 2 decades, and I've been in some conversations with Jeff Booth and myself, and we always look at each other like, 2 decades, huh?
What the hell what are you smoking 2 decades out right now?
There's no way.
I'm not holding shit for 2 decades except Bitcoin.
People who say that have no understanding of macro, in my humble opinion. Yeah. Like, they just don't understand how broke everything is right now.
Yeah. Yeah. Cause when you look at it, like it's shocking tomorrow. Like if I woke up tomorrow, every day I wake up and like the whole global financial system isn't in absolute shambles. I'm like, wow, that's surprising. Like, well, I can't believe we've made it another day. And if it takes another 3 years to really unravel, I'm going to be surprised for 3 years. But it really does just seem impossible that real prices have not just bitch slapped the whole market sideways. Like with I constantly go back and forth between, like, for instance, like there's an Israeli, Ashletter Shaham, something. I can't remember the name, but it was it's a big pension fund. They bought $100 million worth of Bitcoin back in like December or something like that, or November or something. And but it's been, they've made a decent allocation, and then it like tripled since then, and they've since sold off like half of the principal that they actually put into it. But like I see that and I think, wow, like, so the transition actually doesn't have to be an absolute shit show. It would be a shit show for the people who issue the bonds. It would be a shit show for equities that aren't making actual monetary flow. Those things are fine. Like those are the things that need to go, right? Those are the unproductive, capital sucking things in society. But if, a pension fund,
and it's going to be very advantageous for people that are highly leveraged on real estate.
Right.
Yeah.
And then somebody like a pension fund, I always thought like all these pensions are just going to get obliterated. Like everybody who's been promised a retirement is just going to get the shaft. But then I think if they actually allocate 3 to 5% in Bitcoin, and, Bitcoin goes, 10x from there, do they get obliterated? Like, can we actually prop up the foundation just by like really quick shifting it over to Bitcoin before the thing collapses? You know what I mean? Like, well, I can't help but wonder how bad it can get when things can move and shift so quickly.
So this conversation gets a little hard to describe, because what we're doing is we're using US dollars and today's valuation, and we're interpolating them into the future. But let me just give you an example here. Let's say the price of one Bitcoin, let's say Bitcoin replaces the entire fiat system. for unit of account for measuring value.
Mm-hmm.
Let's say the price, and we'll just use it as a really round number. Let's say that value that one Bitcoin is worth, for that to happen in the way that you understand the value of fiat today, that value is $10 million per Bitcoin. Okay. If you buy Bitcoin anywhere to the left of $5 million, if you converted your net worth into Bitcoin for anything left of $5 million, you are going to increase your buying power in this new world. It's just that simple. If you buy it to the left of $5 million, you're decreasing your buying power. I would argue like anything to the right of 7 million, between 7 and 10, is when you would probably start to have some like profound impacts to the buying power that you used to have in the old world.
Mm-hmm.
Right? So now let's say that you're a person that was highly leveraged on your house, like 90% leverage, 10% was actually put down on the house. And you were one of these really laggard type people where you didn't adopt Bitcoin until like the 7 million mark and it went to 10 million. And just so people understand, the price, if Bitcoin takes over, the price of one Bitcoin will go to 100 million. Okay.
Yeah.
But in terms that we can understand today,
talking about value,
we're talking about buying power as we know it today.
Yeah.
That mark, we're going to just use $10 million, right? If that person was highly leveraged in their house and they didn't adopt until really late in the game and they were a laggard, they're effectively going to get that house for free because the contract that they have for their mortgage stipulates that the repayment of it is in fiat dollars. Okay. Yeah. So if they start converting their paychecks and they start getting paid in Bitcoin in this hyper Bitcoinization scenario, they can pay back the house very easily because they're going out and buying one Bitcoin is now $100 million. Okay. Even though we were using the 10, that's why I said it's a little hard to understand. But when you get into this hyperinflation scenario where the currency becomes completely worthless, one Bitcoin will be $100 million or whatever number you want to imagine, it's going to go there. So paying back that loan effectively becomes a free thing for that person to do if they're highly leveraged. So when I think about the person who's going to get obliterated in this, it's going to be a person who probably just retired, who maybe just paid off their house completely. They're out of work. They have a bunch of bonds like that they own, right? Because if you own the bonds, you're going to get obliterated. So you're doing this whole, I'm 60 years old, so I should have 60% of my portfolio in bonds, like the garbage that these portfolio managers are telling you. And so that's the person, and then they're a late laggard to converting their whatever wasn't in bonds over to Bitcoin. Like that's the person who's going to get just crushed on this.
God, it's going to be really crazy to see, like on the house example, like we put essentially nothing down on the house. We got like a FHA loan or whatever it was, specifically to do that, just to hang on to our Bitcoin. And we also knew that we were going to be putting a lot into the house, like we were going to do a lot of work on it, so we'd have equity in it at some point anyway. But this
is something that I want to say about that person. That person that I just described has been a massive beneficiary of the actions that have occurred throughout their lifetime. If this person that I'm describing is accurately depicted as far as age, because think about it. They bought a house at a dirt cheap price. Okay. Now they had very high interest rates, but their advantage was they could continue to re-up or change the terms of their interest rates lower and lower and lower without the price that they paid, which was a really low price in nominal terms on the house when they would have purchased their home. Now, if they were buying and selling homes throughout that period of time, it doesn't necessarily apply. But in generalities, this type of person that I described had a huge advantage through the years up until this point where this event could potentially unravel a lot of those beneficiary actions that they've had through policy.
It's basically like in the grand scheme, even though it's not consistent along like any single person or even a generation, really. But like what you're looking at when you see like these massive market corrections is the undoing of all of the like the not real, the unearned benefit of like the 20 years prior, right? So like somebody bought a house for $40,000 in 1989, and now in 2021 it's worth $370,000. Nah, it's still worth $20,000. You've just been, or $40,000. You've just benefited from the fact that the house has developed a monetary premium from the manipulation of the interest rates. Like that is the spread that needs to be adjusted back down to actually correct for the problem that's happened during that span.
Exactly.
Right?
It's the yin and the yang. It's the offset of everything that was a benefit is now going to be turned into a negative if they don't know how to navigate the change in wind direction. Like if they're on a boat and they're getting their wind from one side and then it shifts to the other. If you don't know how to manipulate the controls on the boat, well, the wind direction that was advantageous on one side is going to be absolutely terrible as it goes in a 180 in the opposite direction.
Yeah. There was a story that when I was first learning about money and Austrian economics, it completely stuck with me. It's never left me. Just because I was like, holy God, that's so crazy, because like you realize how meaningless money is in the grand, like in the scheme of like, it's a trust mechanism. So when trust is lost, so is its value. And it was about the Weimar Republic, and the German mark. And it was a guy who, actually like escaped Germany at the time. But he had, his life savings in a bank, and it was 50,000 marks, which I think at the time like was worth like $150,000 ish when in the value of when I was reading this. So it was 50,000 marks, and it ended up getting like locked up, and he had like fought to like try to get it like out, and just capital controls, restrictions, just everything just didn't happen. And then finally, like 6 months later, they sent him his check for his life savings.
And he's screwed.
And it was 50,000 marks. And the stamp on the envelope that they sent him was a 70,000 mark stamp. That was what it was worth.
Wow.
It cost them more to send the envelope than the check was worth of his life savings. And it just people don't realize how fast that can happen. And obviously it won't ever happen here.
They don't want to believe. Yeah. It's very inconvenient to even broach the subject, let alone allow their critical thinking to interact with somebody like yourself on the topic.
Yeah.
Because I think deep down inside, they're afraid that in that conversation, they might find the truth, and they're not prepared to hear it.
Yep. It's crazy times. It's so weird to see a dichotomy of like, this market is one of the just craziest thing. Like I still call it an opportunity. Like I still say we're alive and watching something at the luckiest time ever, because at the same time, there is this world where things like are just getting absolutely terrible and things are collapsing. But then right on the other side, like you just look over here, and one of the greatest opportunities in a millennia is sitting over here. And it's just like if you ever wanted to live during a boring time, you got screwed. But if you wanted an exciting life with like massive opportunity and the potential to learn, and like when we actually fixed extraordinarily massive problems across the world, like this is it, like this is our opportunity to build things and fix it, because it's all going to be in flux. We actually can adjust and build the shit that fixes all of those problems now. And we have a tool that lets us do it. It's just so fascinating every day. Like,
it's a very exciting time to be alive right now.
It really is. It really is. Maybe that's a good place to end this on. Actually, it's getting pretty late.
Yeah.
All right. What should we listen to?
That felt like 20 minutes. I'm just going to, and I know people who are listening to this probably like, oh my God, are they ever going to be done? But that felt like 20 minutes. So yeah, I have a podcast, like on iTunes. It goes by We Study Billionaires. My Bitcoin show comes out on Wednesdays. There's a lot of like traditional finance, equity conversations, valuation stuff, throughout the other shows that go on throughout the week. But, I'm very active on Twitter, Guy. Huge fan of what you're doing and the media that you're pumping out, because
hey, love it. Thank you.
I love the fact that you're putting out these really important works that you can consume in audio format. And if people have, I always say, like, turn your car into a learning laboratory, because it's just, I have not listened to music probably in my car.
I forgot what music was like.
Yeah, it's just so worthless to me. And I know that's going to upset people, but for me, it's just, I have no interest in any of it. I'm always trying to, if I'm in my car, I'm trying to learn. And so like you making some of that stuff accessible while I'm in my car is such a win. So yeah.
Hell yeah. I appreciate it, man. And everybody knows you, but I'll have your Twitter tag and all the links and stuff in the show notes. But if there is ever something that you want to hear or that you might not get an opportunity to read, hit me up.
Yeah, I will hit you.
Shoot me a DM, man. Yeah. Always suggestions make my job that much easier. So.
Yeah, absolutely. Thanks for having me on.
Dude, thank you so much for coming on the show, man. Been a blast.
Absolutely.